It's worse than we thought as Beijing loses control of its economy. I'm your host, Steven Van Metre, and thanks for joining me today. And a slowdown in real estate in China is already threatening to take the second largest economy into a recession. And with COVID lockdowns, the economy is even in worse shape as Beijing rushes to the rescue in an attempt to save it. But what does this mean for the U.S., China, and the rest of the world? Will China avoid a recession? Well, let's find out as we head over to Bloomberg, who headlines that China's central bank takes modest easing path despite COVID. And the PBOC refrains from policy rate cut. Don't worry, one's coming soon. And lowers the RRR by only 25 basis points. The economy is under strain from lockdowns to curb COVID outbreaks. The People's Bank of China reduced the reserve requirement ratio by most banks by 25 basis points, or 0.25%, lower than economists had expected, and dropped it by 50 basis points, or 0.5%, for smaller lenders. It kept the one-year policy interest rate unchanged, disappointing a majority of economists who predicted the cut. But don't worry, they are going to be lowering their rates. There is a reason they didn't, and I'll explain that here in a little bit. Let's continue on, because here you can see the reserve ratio cut as China's average reserve requirement ratio for banks will drop again, but you'll notice it's already very low. It's well below 10%, and a quarter basis point wasn't a whole lot. But what is going on here and what this means in a fractional reserve banking system is when you put $1 on deposit, well, you're required by the central bank to keep so much of it on reserve. In this case, in China's reserve ratio is over 90%, meaning they can lend out over 90 cents on a dollar. And the idea being, if you cut the reserve ratio, well, more money gets out in the economy. Let's continue on, because the main challenge the economy faces is the Omicron outbreaks and the lockdown policies that restrict mobility. More liquidity may help on the margin, but it doesn't address the root of the problem. The change, effective April 25th, will unleash about 530 billion yuan, or $83 billion of long-term liquidity into the economy, the central bank said. The PBOC last reduced the ratio in December. So what does that mean? And what's happening here is, as they reduce the reserve ratio, the idea is that banks are going to go out and lend all that money that they can. Now, in countries like the U.S., the government can't force the banks to lend. Now, someday we might get to that scenario. In China, well, they can put heavy pressure on the banks to lend and get money out in the economy. And that's what they're saying here is, we're going to lower this reserve requirement and we're effectively going to push the banks to lend. But there's a problem with the country being in lockdown in various stages. What good is easing if people aren't there to borrow it? And that is a problem. Loan demand remains weak amid lockdown measures and a property market slump. The banks are unwilling to lend in an increasingly risky environment. That means any rate cut will only have minimal effect on economic growth. And that is exactly the point of what's going on here. Why we actually didn't see a rate cut from the PBOC is because it won't matter. If people can't go to the bank and borrow because they're under lockdown, well, it doesn't make any difference. So this is more kind of a way to tell the world is, hey, we acknowledge there's a problem here and we're doing something by cutting our reserve ratio, but we recognize it's not going to do much, but it's just the beginning of perhaps why we're going to do more, as we're going to look at here soon. And one of the things that's going on that's really interesting, I get a lot of questions about the U.S. bond market and what's going on with yields, and we can see that the premium is gone. If you take the China and subtract the U.S. benchmark yield, the gap vanishes under divergent policies, where we see China easing and the U.S. tightening. And what this means right now is there's no difference between purchasing a 10-year China bond and a 10-year U.S. bond because the yields are the same. Now, this is interesting because if you think of this from an investment perspective, if you were going to go out and buy a bond, you can either purchase one from China at the same yield and take the risk of perhaps a potential default there, or you can buy one from the U.S. at the same yield where your default risk is effectively zero. Well, that makes it more interesting and perhaps turns the tide on the end of rising rates in the U.S., as perhaps investors around the world will now see higher yields in the U.S. as an advantage to take of that risk-free rate. And let's look at what happens now when we see these bottoms and where these gap between the two is either minimal or zero. Now, I'm going to use the 30-year Treasury only because it's more exaggerated than the 10-year. And I know the last chart was using the 10-year Treasury, but I want to note that back in 2010, when there was an advantage to buying U.S. Treasuries over China's government bonds. What happened? U.S. yields went down. We saw that back in 2015. It got down into here. You can see this right here. And look what happened. Yields start to go down. The next time is 2018 right here. Again, there was still an advantage to purchasing China bonds, but not much. And what happens, of course, yields go down as the world looks toward U.S. sovereign debt. And now the belief is rates are only going higher, but perhaps we're going to see investors flood into U.S. paper. The room for further reserve ratio reductions may be shrinking, though. Economists say the central bank may soon need to shift away from widespread use of the RRR, as it is already relatively low, is becoming less effective tool to deal with the economy's structural challenges. And that is one of the problems with these extreme monetary policies, is you get to a level where it just can't go much lower because you risk blowing up the system. And you start to look at the U.S. and what we've done is we've gone to a zero interest rate policy that we're trying to get out of. The Fed expanded its balance sheet to unheard of levels, and now we're draining the strategic petroleum reserves to deal with inflation. And it all tells you is if there is another global financial crisis or even a global recession, whether it's triggered in the U.S., China, or somewhere else, what are central banks going to be able to do? What are governments going to be able to do? And the answer is almost nothing. And that is a risk to your portfolio and one you shouldn't be taking. And if that bothers you, well, check out this link up here in the corner in the description below, and you'll see perhaps Portfolio may be the answer for you. Let's continue on with this story because things in China actually aren't looking any better from the central bank's perspective as we get ready for the next supply chain shockwave that's going to roll through the world as cargo backlogs in Shanghai, a precursor to global port congestion as COVID crisis drags on. And it's probably worse than Wuhan, said John Monroe, an ocean shipping and supply chain expert who runs a consulting firm. He says you're going to have a lot of pent-up orders. It's going to be overwhelming movement of goods that will drown shipping lines and ports once lockdowns are lifted. So for the moment, what we're seeing is perhaps a reprieve as China shuts down. The ports out of Long Beach and Los Angeles and around the world are going to be able to work through their cargo backlogs. And then once the restrictions in China are lifted, guess what's going to happen? A flood of cargo is going to hit again. And that's what he's referring to. Shanghai is one of the largest manufacturing centers in China with heavy concentrations of automotive and electronic suppliers. It is home to the largest container port in the world and a major airport that serves inbound and outbound cargo. Exports produced in Shanghai account for 7.2% of China's total volume and about 20% of China's total export container throughput as it moves through the port there. Most warehouses and plants are closed. 9 out of 10 trucks are sidelined. The port and airport have limited function, and shipping units are stranded in the wrong places, and freight is piling up. More and more, the logistics impacts are rippling beyond the contagion epicenter. So what does this mean for the rest of the world? Well, it means higher consumer prices as the world's largest exporter is having trouble producing and getting products to the rest of the world. But what does it mean for countries that aren't in lockdown that compete with China to export to countries like the United States? Well, this is called an advantage because now they can come in and say, look, we can produce goods, we can ship to you, and perhaps they can get buyers in the U.S. to switch from their providers in China to them in these other countries. And that's one thing that China is really worried about, is losing to other countries here. Now, one thing we hear a lot about in the U.S., an issue which we're going to debunk, is how higher producer prices lead to higher consumer prices. Now, it kind of makes sense as prices coming out of the factory and into the factory in the U.S. lead to higher consumer prices. But it actually doesn't. And I want you to understand, because when you really get how the global economy works with the dollar being the reserve currency, you start to see it in a different light. So let's head over to this headline, which I thought was fantastic because I disagree with it. And this is from Zero Hedge. Producer prices soar at record pace. Pipeline suggests peak inflation. Far off. But yet, here we can see in this chart, the PPI, the month-over-month numbers are off the scale. You go back to the pandemic lows and it's just way up every month, higher and higher prices. And you can see the year-over-year rate change at 11.2%. And gosh, it's got to mean inflation. But yet when you overlay the CPI in blue and PPI in red and keep them on the same scale, on the same side of the graph, you'll notice there isn't much of a relationship between the two. In fact, you see here here, you see rising producer prices through the 2000s, and consumer prices kind of modestly rise. And then look, going into the great financial crisis, producer prices shoot higher. And yes, consumer prices go up, but nowhere near as much. The relationship isn't there. And how about coming out of the financial crisis, 2010, 11, 12, producer prices back up? But notably, inflation really wasn't there at the same level to the consumer. And here we are with PPI way off the charts, and everyone's assumption is a CPI must go up. But why doesn't that happen? Well, it has everything to do with how the global economy works. Because when prices go up in the US, they don't necessarily go up other parts of the world. And so when the world's largest importer has high producer prices, foreign producers say that's an advantage. And so think of it this way. Let's say you operated a taco cart, and 3 blocks down, there was another taco cart, but they were in a taco bad zone where it was really expensive to produce tacos. There's lots of taco regulation and laws and rules about the production of tacos, and their costs were really high and rising because of more costs that are being tacked on. But you were outside of that taco zone, and you could produce tacos at a much lower price. Well, all you would have to do is produce the tacos at your truck and then have someone ship them into the taco zone of extreme pricing and sell them at a discount. And that's kind of the idea of what goes on here. So when producer prices rise in the US, everyone else sees that as an advantage to make a ton of money because prices here go up, but their prices to produce aren't going up as much. So their margin of profit by exporting to the US, well, gets even better. And that's why we see this chart and this relationship now. When we look at the trade balance or trade deficit, which is an excellent way of looking at this gap, and we overlay that against the producer price index in red on a year-over-year rate of change, and you can see now in the 2000s as producer prices were rising, you'll notice that imports into the U.S. were increasing, and that's when you see the blue line going down. That means you're seeing more and more imports, and that is simply because foreign producers could make more money importing to the U.S., particularly as producer prices here were rising. And now, look what's happening here. Producer prices shooting up and imports at record levels coming into the U.S. simply because everyone's taking advantage of this mismatch. So from China's perspective, while their economy is in big danger, it's opening doors for everyone else to import to the US and perhaps take some of their market share. But the real risk is if China can't pull out of this, because monetary policy was never designed, despite its attempted use, to fix pandemic problems, to fix global supply chain problems. It doesn't do that. And if China can't pull out of this, well, the rest of the world's going to be in a big trouble and perhaps facing another recession. And with that, I'm Steve Van Metre. Thanks for being fans. Thanks for watching. Bye now.